Everyone, and welcome to the Real Estate Trends in New York. We are about to have a very dynamic hour. I'm Grace Vandecruze. I'm a proud graduate of Pace University, BBA in accounting, class of 1985. And after Pace, went on to get an MBA in finance from the Wharton Business School. I've had a long career as an M&A expert on Wall Street, and I now run Grace Global Capital, which specializes in mergers and acquisitions, mainly in the insurance industry. I also sit on a number of corporate boards, including the Blackstone Group, REIT board, Link Logistics. And it is a pleasure to be here, and you will hear from our two panelists, both Joe Tirone and Vic Kukar. And before I turn it over to them, just wanted to go over a few housekeeping rules. One, please mute your phones and your lines to avoid any disruptions. Secondly, there will be a presentation. After the presentation, we'll be taking questions. Please put your questions in the chat room, and we'll be addressing as many questions as possible. And just a reminder that this is being recorded and will be available at the PACE website within a few weeks. So with that, I will turn it over first to Joe and then to Vic. Joe, go right ahead.
Okay, thank you so much, Grace. And thank you to Pace University for having me here. This is very exciting to do this and to share my expertise and my view of what's going on. It's a lot of crazy things happening. So I'm a Pace graduate as well. 1979, I got my BBA in accounting. And then in 1990, I went to St. John's here in Staten Island. I received my MBA in finance. And then my first job out of college was with Jerome Belson Associates. I was the real estate manager for they're a big property manager in Manhattan, which they still are. And I was at Rupert Yorkville Towers, which is a upper East Side, on 90th and 3rd. And then from there, I went to E.F. Hutton, where I worked on the trading desk as trade support person in equity trading. And then I converted over to mortgages trade support over at First Boston, where I then transitioned over to mortgage finance. And I transitioned during the FDIC and RTC days with the first big bank crisis. And we were buying large portfolios of residential non-performing loans and did that for several years. The most notable portfolio was a dime portfolio. They had to sell their non-performing assets, get them off their balance sheet so they could stay solvent. And that was an unbelievable portfolio. It was about 300 million. And then as a consultant, I worked with Steinhardt Partners later in the 90s. And they had securitized Citicorp's non-performing loans. That was their way to get it off their balance sheet. And that was an amazing portfolio. That was the largest of its kind, over $1 billion. And I ran the REO portion of that out of Jersey City, 300 million of REO in the tri-state area. So that was quite a task. And then I went on my own for about 20 years, where I was buying and selling loans, but mostly I was renovating and selling, which is like everyone does now. But I was, when I did it, it was pretty novel. And so then after that, I ended up, I always had my broker's license so I could accommodate that part of my business. And then in 2019, beginning of 2019, I partnered with Compass, and I brought them here to New York City, to Staten Island, I'm sorry. And because they were in all other boroughs at the time. Compass Greater New York is here in New York. We have about close to 3,000 agents, but countrywide, there's over 25,000 at Compass. And so I'm enjoying that relationship. And one of the reasons I joined that was to get involved in new development. My passion in new development is for middle income housing, which is a portion of affordable housing, and middle income is pretty big on Staten Island. Another thing, I guess, it was of importance in 2012, in response to Sandy, I got very involved with the community, and I was the organizer of the largest buyout of its kind in the nation's history. It got 550 families in Staten Island were bought out at the pre-storm values of their home, and that's chronologized, whatever, in my website, which is called foxbeach165.com. and you could see that there. And then I guess of interest, another thing that I've done is I started a wiffle ball tournament up in Vermont 20 years ago, and we raised over 20 years over $9 million for people with spinal cord injuries. And I brought my team up from Staten Island to compete up in Vermont. It was very interesting, a lot of fun, and it was worthwhile. Anyway, Vic.
Okay, thanks, Joe. Thanks also to Pace University for having us. Michelle, Grace, Mark, thank you for setting this up. And thank you all you men and women who are on board listening right now. I'll give you a quick background about myself. I graduated from Pace undergrad in 1997. Seems like an eternity ago. I was then an accountant for about a decade in the city in Manhattan, got my CPA, worked for some public accounting firms, then private, AIG, Robert Half, for example, then got an MBA from Carnegie Mellon. And a year later, I decided to become a real estate agent. Now I've been doing it ever since then for the last 15 years plus. I love it. I do it full time. I work primarily in Manhattan, a little bit in Queens and Brooklyn from time to time as well. So I'm sure that many of you guys who are listening probably watch Shark Tank or have watched Shark Tank before. If you have, you probably heard of Barbara Corcoran. So her company bought the first real estate brokerage I was with, which was City Habitats. I left City Habitats, went to Runnenberg, not because Barbara Corcoran bought it, not because her company did, just because it was time to move on. And I was then at Runnenberg, now called R New York in the city, for about another 8 years. And about 3 years ago, I joined eXp Realty, and obviously been with them ever since. And I basically do, I basically help people with their real estate goals. What does that mean? That means, whether they want to buy, sell, or rent their property, whether it's a condominium, co-op, townhouse, brownstone, rental property, even some commercial work as well. That's what I do. And I love it. And I'm looking forward to doing it for the rest of my life. Thanks. And that's about me.
Well, thank you, John Vic. It's an honor to really be here with you. Before we get started, we have a poll to better understand who's joining us today. And so there's some short questions for you to answer. One is, are you a current homeowner? Are you looking to purchase a home? Or are you a potential investor, or none of the above? So please take a moment to answer that poll, and we will review the results. So far, we're getting an overwhelming 89% of you are current homeowners, and actually that's going up to 91%. So that gives us, and 9% is looking to buy a home. So that gives us a perspective of where you are right now. Now on the topic at hand, how did the current real estate cycles change the pandemic? And I will ask Joe to address this question.
Okay, sure. Traditional real estate cycles, I mean, they're always influenced by supply and demand, obviously, and then interest rates and the economy. And so when I think of this question as traditional real estate cycles, I'll go back to cycles where things suddenly changed. And that would be in both experiences I explained before, in the late 80s with the RTC crisis, what happened with the inventory then, because there was a tremendous increase in supply, mostly because of foreclosures and the failures of banks. And that increase of supply really affected the market value of the homes. And as foreclosures continued, there was a continued pressure on prices. And then, and that lasted for a while. And it wasn't until all of those write-downs and all of those foreclosures sort of washed through the market And then there became more of a balance between supply and demand that took several years, well into the 90s, for it to actually start to calm down and then reverse. And that lasted probably until 96, 97. And then, of course, people remember better the 2008 problem, which was again write-downs, but because of the bad debt with the CMOs, where there was this pressure for underwriters to underwrite loans to feed Wall Street more product because it was very profitable. And by the way, when I worked at First Boston, Larry Fink was there, and he was the one who created the first CMO, which is a great vehicle to create liquidity. But like a lot of things, what happens, it gets abused, and it got abused in 2008. And that took a while. As a matter of fact, I stopped doing what I was doing, buying homes and selling homes and even being real estate, to teach economics at St. John's as an adjunct professor while all that was happening. And it was kind of fun for our class because we kind of predicted what would happen to the economy as a result of it. And it rang true, because what happened was a lot of what was happening with the economy was being financed by people tapping into the equity of their homes. And once that dissipated, the economy, really, there was a shock to the economy because its spending just stopped. And that took quite some time, probably till 2012, when things started to level out there. And I remember that specifically because that's when the buyouts happened, when people were getting the pre-storm value for their homes and they had to move. I knew it was a great time for them because it was really when the market was starting to recover. So they were getting pre-storm value plus 15%, and they were putting that into homes that were safer in areas that would continue to appreciate without the risk of flooding. So it was really an amazing way to recover, and I give Governor Cuomo credit for recognizing that so quickly, because it was one of the fastest buyouts ever. So that brings us to here. Am I predicting another crash? No, not really. But there are things that are in place, and we'll talk about it in a little bit, about the rising interest rates and this change in supply and demand. But we don't really see that yet. So what's happening, where are we in this cycle? No one knows. If you look at all the statistics, it's pretty amazing, because you're seeing a lot of the literature out there saying that prices just hit new records. And they did. In April, there were new records in terms of volume, in terms of price, everything. But that was deals that were closed at a 3% mortgage rate. So what's going to happen forward? I'm not, we're going to talk about that a little bit later in this discussion, but we're certainly at a tipping point from my perspective. Vic?
Very interesting. And we will get much more into the inflation and rising interest rate and some of the key catalysts that's impacting the market. Vic, I'm going to turn to you for our second question. Early in the pandemic, we heard about New Yorkers leaving the city in record numbers to the suburbs. How did that change the market, and how did it pan out in the long run?
Thanks, Grace. Let me just touch on the previous question for 15 seconds. So just to let you guys know, in Manhattan, what had happened right before the pandemic, the lockdown, which was March 2020, is the market had been kind of down in Manhattan. So let's go on the down cycle. And in January, February, we saw signs of activity in life, and you can hear it just by speaking to other agents. Hey, the market's finally picking up, and there we're going to go, we were on our way up. I don't know how far, but we were. And then bang, lockdown. And everything pretty much went to a standstill because we were not allowed to show, I think, for about 2 to 3 months. We did a lot of virtual tours. And even then when we opened up several months later, being actually able to physically show, we still did a lot of virtual tours, we being agents in general, not just myself, but those I spoke to. But yes, it's like most of you have probably read, there was a mass exodus from the city when the pandemic hit. Maybe not as dramatic as they make it out in the media, but still, it was very big. Let me give you an example. I used to walk into buildings and speak to the doorman, and I'd be like, hey, Joe or Fred, what's going on? You have only 50% of the people here? And they'd be like, Vic, we only 75% of the people have left. There's only 25% of the people remaining in the building. And I heard this in a lot of buildings throughout Manhattan in 2020. Now, I don't know where they went. Maybe I know where they went. They generally went to suburbia, but did they have an extra house there? Did they have a vacation home? Did they stay with their mom and dad? Did they stay with another family member? Probably a combination of everything. So Manhattan, the rental and sales market was really down during the pandemic, down in 2020. But in October of 2020, things slowly started to change. Sales started to activity actually started to pick up then a little bit, and every month it got better. And then in 2021, we set records across the board in Manhattan sales and even rentals. So in 2021, we had the most sales in Manhattan in 32 years, which was almost double that of 2020. And when I say in 32 years, that's how long they were keeping records. There was $30 billion of sales in 2021 for Manhattan, another record. So how did it change the market, the pandemic? It went down, but it only went down probably somewhere between 6 to 12% in Manhattan. Yes, some people got some amazing deals, like 15 or 20%. They found desperate sellers, but overall in Manhattan, it was about 6 to 12% down. Brooklyn and Queens, I heard, held up actually pretty well. And I think Joe can definitely speak about Staten Island and how it held up regarding that. But now Manhattan is back at its peak in the last decade, which most agents think was either 2015 or 2016. And right now, we are red hot still. Demand is hot. The rental market is hot. But I will say this, and we're going to discuss this later, that it could change any day or any week, because of what we're seeing in the whole economy and mortgage rates. So that's what happened to New York City and Brooklyn and Queens, where they held up, and New York City, Manhattan really got hit, but has really boomed way back to peak demand in the last 10 years.
Wow, so much of what you, Bake and Joe described impacted many of us. I left New York City, Manhattan during this pandemic, came back, purchased my next door neighbor's apartment, combined the two apartments, went through renovations. So very, very interesting times that we live in. Joe, I wanted to get back to you on a topic you talked about, and that's the rising interest rates. By now, we all know it's increasing. Can you describe how mortgage rates are affecting sales?
Sure. Well, there's two things I want to talk about with that is just statistics that just came out. NAR just came out with a statistic about a week ago where they surveyed first-time homebuyers. This is a nationwide survey, so it's applicable to where we are in New York City. I'm assuming most of the people in the audience are from New York City. But nationwide, they surveyed people, first-time homebuyers, to ask if this was a good time to buy. And 19% said it was a good time to buy, which was an all-time low. And so you have to, you look at that and you say, now, why was that an all-time low? How is it an all-time low? Well, Realtor.com just came out with a statistic also about 2 days ago, and they said that homes are now 50% more expensive than they were a year ago. This is, again, nationwide, so here it's probably a little bit different, but I would guess it's even higher, you know, because, and that all depends on how, because that's a combination of two things, right? That's a combination of rising prices and rising interest rates. So, so that really has exacerbated the importance of affordability, and affordability is really becoming an issue in the market, in some markets. Now, in Vic's market in Manhattan, I know that there are plenty of cash buyers still, and in Staten Island, there still are there are people who can still afford their mortgages at the current prices. But I'll give you an example. And we had an open house about maybe 3 weeks ago, a very desirable area in Staten Island, that if we had done the same open house in January, February, we probably would have had the same amount of people looking. So, and that's what we're finding. There's still a lot of buyers out there. So in that open house, it was a record for us. We had 62 families walk through the house, over 300 people in a I think it was a 2 or 3 hour period. So it was amazing. And then another 20 people came through the next day or two. And we ended up only getting 3 offers. So my agent called the other agents who came through and said, "You're going to get a full price offer, let us know, keep us, because we're used to these price wars and everything." So we were expecting to have, 15, 20, maybe 30 people bidding on the house. But what happened was 2 things. Either they looked when they got their pre-quals, because they went back to the office to get pre-qualified. They either looked at it and had sticker shock and said, "No, there's no way I'm paying for this, this amount of money for this. I'd rather stay in rent or wait till something happens, the market comes down." Or, which happened a lot, because you talk to the mortgage people, they could not afford the home. Whereas they were pre-qualified, they went to the house knowing what they were going to put down, knowing what their mortgage would be, and then found out that they couldn't afford the home. So we think there's going to be, in that end of the market, there's going to be a compression where people are going to be forced to look at lower priced homes. But interest rates have had a tremendous effect on demand, but what's happening is really an anomaly right now, because you still have plenty of buyers, and you have sellers who are convinced that their prices are holding, and they're gonna hold out for a while. I don't think they're gonna recognize this potential market shift, and so prices will probably remain stable. And in Staten Island, prices have, if you look at what's closing, they're continuing to rise, but I think that's going to start to level off. And I think Vic might have a little bit of a different perspective on that, because I think in Manhattan and maybe higher priced areas, and in Staten Island as well, in the higher end, it's not so sensitive to these changes in mortgages. And then one thing I'd like to point out is that a lot of the statisticians and analysts look at this and they'll say, 5.5% doesn't really matter, because historically rates have been around 6%. And that's 100% true. However, so there's still kind of a discount. So people get excited. And Vic and I were talking about how when rates went from 4 to 5%, especially in Staten Island, there was this frenzy to buy, because people all thought that the rates were going to continue to rise. But the fact is that rates are now, close to 6%, which is close to the historical average. But it makes a big difference right now, because rates just came from 3%. Mm-hmm. So that unprecedented rise in rates is having a direct effect on the here and now. And it hasn't shown up yet in the statistics, but I believe that it will. At least in the more middle income, maybe middle to higher income areas in Staten Island, the 700 to 900 range, that's what we're finding. But the lower price ones, they're still doing really well, and they might even do better in this market. Vic, what do you think?
Thanks, Joe. Let me give it from the Manhattan's perspective. What's going on right now? The question was, how are mortgage rates affecting sales? And right now in Manhattan, it's not really affecting sales, and the data is showing that it's not really affecting sales. We are in a red hot market in Manhattan for sales and rentals. But right now, and I'm going to share a couple of charts with you guys so you can see how the data is supporting that as well. So give me 1 second. Let me share the chart here. All right, guys, can you see this chart? Okay, so here we go. Let's go. All right, here's a chart regarding demand. And this is just for Manhattan, guys, for those of you who are listening, okay? Right now it's saying here, excuse me, I'm sorry, pending sales leveled off over the week, even as the busy season is peaking. Well, we are getting towards the end of the traditional busy season in Manhattan, which is spring and fall, but the demand is still very strong. And is it leveling off? But that's fine. That still means the demand is strong. So right now in Manhattan, we're not really seeing mortgage rates affecting sales right now. Let me show you another chart. New listings, okay? This is a chart just showing new listings that are coming to market in Manhattan, all right? And once again, we're seeing a lot of new listings coming on to market. And we were actually slightly below the average in Manhattan. So new listings coming onto market is actually a good sign of the strength of the market as well. And I think I'll show you one more chart, guys. I think 3 charts is enough. This is contracts signed in Manhattan, all right? And we're still above, normal averages. We were setting records in 2021. We're going to have so far we've had a really good year, the whole Manhattan real estate industry in terms of sales. So people are still out there and they're still signing contracts. So what does this mean? It just backing up with data, what I'm seeing myself and what I just said a couple of minutes ago is that Manhattan for now is still very strong and mortgage rates don't seem to be affecting it. However, big however, I think that it could be any day, any week, might even be 4 or 5 months from now, but as mortgage rates increase, which I think most of us expect, and there seems to be a very high probability of that, especially with the Fed coming out and saying they'll do it, we are going to see more, these increased mortgage rates affect the pricing in Manhattan and the demand. And for many of the reasons that Joe said, because your monthly cost just goes up and it makes things unaffordable. And even though Manhattan does have basically 50% of the sales year in, year out in all cash, those people buying all cash are not dumb. So they'll know that, hey, the market's coming down, they'll see it, and they're not going to pay above market prices for the properties. So I think we are going to see, whether it's next week or 4 or 5 months from now, that Manhattan sales will probably come down in terms of quantity and price because of the increased mortgage rates.
Excellent points. Vic, I wanted us to just change topics for a second.
Please.
And look at the supply chain issues. It's been on the news. We're all experiencing it in every single industry, but certainly it impacts the real estate market. So can you discuss that a bit?
Sure. Let me start. So it does affect every industry, and I think we're all seeing it from the cost of my everything bagel with ham, egg, and cheese and coffee in the morning to what my lawn guy is charging me now to cut my lawn. But I think that Joe and I probably don't see it too direct. And I'll tell you what I mean by that. We're not developers who are probably getting hit by the supply chain issues. They're longer to get their flooring, longer to get their vanities, longer to get their cabinets. People maybe not working as much because of the pandemic. They're probably getting hit even harder. I am seeing with some of my clients, I should say, that when they want to do renovations, well, if it takes an extra 2 or 3 months to get their vanity, it delays the renovations as well, okay? And the contractors were so busy in 2020 and 2021, and they might still be and they're still pretty busy now, that people are paying more for their renovations, and it's taking longer sometimes to get contractors as well. I'll give you an example. I have a co-op. We're actually in contract, about to go to the board, was listed about 5 weeks ago or so. But right before that, I was speaking with the owner and the stager, and the owner had $300,000 ready to renovate this 2-bedroom, 2-bath co-op in Chelsea. And, we spoke about it. We said, look, it's going to take maybe 9 months to renovate this apartment. Why? Because the contractors are so backed up that they don't have time to work. They're pushing everyone back, and it takes longer to get what you need to renovate the apartment. So we just decided to have it staged, which I think was a wise move. And, fortunately, we got an accepted offer within a week. So that's what I'm seeing with the supply chain issues. It's more along the lines of longer to do renovations, but it's not really affecting demand or selling or buying from what I've seen in Manhattan in that regard, from the transaction level.
Joe, would you like to add to that?
Sure, thank you, Grace. Supply chain doesn't really affect the resale market, except for what Vic was saying about when people doing maybe a major renovation. But our clients who are waiting for new construction projects, they're waiting longer, because of the supply chain issues. And then the builders who are looking for different parcels, different properties here, are being much more selective and much more wary of the market because they're afraid of prices and supply chain delays. And time is money for everyone, but especially for them. But I can also tell you that on the new development side that I'm looking where we're advocating, my commercial team is advocating for middle income projects, which is basically mid-rise for the most part, not really high-rise. We have several parcels that we are marketing, and we're working with architects doing zoning analysis to see what fits in, what you can do as of right, and so on. And we were very close to a deal several months ago. And when this really came to be a really very strong issue, which it has been, and they saw that it really was not changing for the better, they actually backed out of the deal because of the question in terms of how they could price their deal in terms of what the construction cost would be. So it's having a direct impact on that. And I'm sure that's having a direct impact on some projects in Manhattan as well, I would imagine. But especially on a newer type project, because there's really not that many type of development projects on Staten Island, because there's an inherent risk to that. Like, is this going to be received well? And then when you add to that the additional cost because of supply chain, it kind of just kills it. So we're working through that, and we're hoping that we're going to announce a deal shortly. But it has impacted that segment of the market.
Very interesting. As we come closer to our prepared questions here, wanted to ask both of you, what do you think the future holds for the real estate market here in New York?
Joe, you want to go first or me?
You can go.
All right. I'm hugely optimistic about the real estate market in New York City. And that is because I've lived in New York my whole life. I lived in Manhattan for 15 years. The focus of my real estate business is New York City, Manhattan. And I think that actually this pandemic and coming out of it only supports that optimistic view. New York City is it's almost like a cockroach. You can't kill it. You can't end it. From the riots in the late 70s, when there was blood on the streets, as people like to say, to the terrorist attack in 2001, to the high inflation before. New York City, Manhattan, and I'm going to give a special shout out to Brooklyn because it's really come a long way. No disrespect to the other boroughs, because I think Staten Island seems to have come a long way too. But New York City real estate just keeps on going and going and going. When we had the Great Recession, property values around the country, I believe, dropped somewhere between 30 to 40%. And they took a lot longer to come back. Manhattan did drop about 20%, but leveled off after 9 months and then started coming back. So its resiliency is amazing. All the people who left, to go back to one of our earlier questions during the pandemic, look, some of them came back, but some did not. And guess what? There's scores of people who have come in and taken their place in Manhattan, because that's why we're having so many sales. That's why the rental market is so hot. That's why when you speak to New Yorkers, you're like, yeah, the city's back. It's the people are out there. They're shopping. They're going to restaurants. You can see it. And I think anyone who was in Manhattan in 2020 saw what a dramatic difference it was when people were away and staying in their house. So if you're a long-term investor, 5 to 7 years or more in Manhattan, I think the future is so incredibly bright. Manhattan, I checked a couple years ago, of all the international cities, Manhattan was ranked 7th in price, with Hong Kong, Geneva, London, Moscow, even Mumbai being higher. So New York City is in what is considered the safest probably country and has the safest financial instruments, the US dollar. So it really is in great demand. We don't just have domestic buyers and renters, we have people coming in from all over the world, whether it's Europe, Canada, China, Asia, Africa, South America, you name it. So I think the future is incredibly bright, and I think this rebound from the pandemic only supports that even more. That's my view on the future.
Right.
Okay, so you wanted me to take that as well,
Yes,
Grace?
yes,
Okay.
go right ahead.
So, okay, so just really briefly, I mean, you asked earlier about the pandemic and what the direct impact was that we're still sort of dealing with. But one of the things that I noticed in this cycle, we talked about cycles before, was that when the pandemic really first started, there was a phenomenon that I had never witnessed before, and that there was both panic buying and there was panic selling. And I had never seen that. And so as agents, we were busier than ever because we're trying to accommodate both ends of it. And then it ended up where there was just way more demand than there was supply. So that had a tremendous effect on the Staten Island market and everywhere else. So, but Staten Island was one of the places where people sought refuge. And so we were getting, really for the first time, there was several months where we were getting one Manhattan buyer after another Manhattan buyer. And they were, for the most part, they were ending up in the buildings, the mid-rise buildings in the St. George downtown area. But they were also buying the luxury homes in Toad Hill and other areas in Staten Island. But for the most part, they were going to other buildings, which I thought was a little bit odd. But they just wanted to be on Staten Island. So where does that leave us? You know, in terms of what is the future? Because even though New Yorkers in Manhattanites and people from Brooklyn especially sought refuge in Staten Island, they were going to make the move for all these years, and they finally made the move. And they came here. And so that was, you know, obviously a big pickup for the market. But there's a lot of people in Staten Island who are, you know, been here a longer time, who are seeking refuge in other states. And so North Carolina, South Carolina, Florida, anywhere south, really. And so, but this transition that continues to happen, there's always someone to fill the demand. And but I do think that as rates continue to rise, that it's going to level off. I really don't see a crash like we saw in the other cycles. I would be really surprised to see that, unless rates get out of control. And what is out of control? 8% or higher. And then all bets are off. Then at that point, there has got to be, you know, you have people who have mortgages that are going to adjustable, that are going to adjust higher. So they're going to get into trouble. They're going to have to sell. It'll increase the supply, lower the demand, and then, you know, God knows what would happen. So we're safely below that right now. But anything getting close to 8%, I think, would spell trouble for anyone, anywhere, really.
Wow, great points. You know, New York real estate and resiliency in the same sentence have gone together for a long time. I purchased in Manhattan my first apartment right before 9/11, and I've seen the resiliency of that market.
Yeah.
One of the things I'd like to drill down into, that a question came in, and it says, in which neighborhood do you see the best value in New York City?
Okay, well, I'll speak about it from Manhattan, Joe, if you don't mind.
Yeah.
I get this question a lot from my clients. I've been getting it for many years. And here's the answer I usually give them. You know, they might not like it, but it's really my firm belief. I tell them, look, if any neighborhood below 100th Street in Manhattan is generally a good investment. And it's not to say the neighborhoods above 100th Street are necessarily bad. No, there's some places like Manhattan Valley, Hudson Heights, you know, by Columbia University, where, you know, if you, that effect too, which are also very interesting. But generally below 100th Street, most neighborhoods are excellent. When you buy property there, you know, it's liquid. You get a lot of buyers who want to be below 100th Street. They really do. So whether it's Gramercy or Financial District or Chelsea or Upper East Side or Upper West Side, Nomad, they're all great areas to invest, in my opinion. But there was several years ago on the Upper East Side when they opened up the subway. That was, I thought, a really great time, or right before, a year and a half, to invest in the Upper East Side, because I knew that that upper side, that subway on the Upper East Side was really going to increase property values, and it did.
Yes.
I had 2 apartments that came up for sale on the Upper East Side just after they opened up the subway. Both sold on the first day. Okay. Also, now I like to pat myself on the back and say I'm super amazing, and I do think I'm very good with all humility, but that Upper East Side subway effect really was very helpful. And right now, I would say the area around Hudson Yards is extremely interesting. I know they've been building it up for years, but not just the Hudson Yards area, but even some of the neighbors that touch it, they're, I think going to see a little bit, just a slight bump, just because of Hudson Yards as well, because it really is a massive structure. People love being over there, and I think it's going to revitalize that part of the city, plus have a residual effect on the neighborhoods touching it as well. So that's what I like right now. I'd say Hudson Yards, but really anything below 100th Street is generally a very good investment in Manhattan, as long as you're not looking to flip it right away.
Very good. Joe, what's your thoughts?
Okay, sure. I mean, I think if you look at Manhattan, you think about cap rates and where the highest cap rates, you're probably talking somewhere between 2 and 3%. So there's certainly an investor for that, but maybe for the people on this call who aren't looking for multi-million dollar investments, I think that Staten Island actually is one of the places, certain areas in Queens and the Bronx, where you can get cap rates over 6 or 7%. And you can get it for a decent property. I mean, a client of mine just listed in the downtown area mixed use projects, which is basically a storefront, 2 or 3 apartments above, at I think 7 caps. We just sold one, a 2-family over a storefront at a 8.5 cap. So the cap rates in the boroughs, in some of the boroughs are higher. So if people in the audience here are looking for a real estate investment that is going to be a long-term investment, I think that these mixed use, small buildings, maybe 8-family or less, or even 4-family or less, really, to stay under the radar with a lot of the city ordinances, you can still find value even in this market. You have to be, it's very, very selective. When something pops up, it does trade pretty quickly, but there definitely are opportunities, and we're finding them here. And I know that they also exist, especially in the Bronx and in certain areas of Queens as well.
Very good. Just wanted to remind the audience that we're taking questions in the chat, so please place your questions there. And while they're doing that, there's a very fascinating question that came up, and it's regarding companies giving up their commercial lease spaces, and those spaces being used as spaces for experiences. And could you explain, and I'll leave it to both of you, Joe and Vic, what does that mean, and what are some good examples that you've seen?
All right, I guess I'll go first. Yes, companies giving up their commercial space. Yes, you get it. They couldn't get workers to come back, and they didn't want workers to come back for what, almost 2 years. Mm-hmm. And even now, I've been hearing enough from friends and family and contacts that, they're only going into the office maybe 2 or 3 times a week. Not everyone, some are back full time, but a lot of people are just going 2 or 3 times a week. And I'm also reading articles saying that, hey, a lot of people are not coming back to their corporate job. They don't want to. They don't want to be in the office. And we are having a resurgence in COVID. But I think that those owners are going to find out and do what they have to do. And those spaces are eventually going to fill up. Are they going to fill up with something else, a hybrid, a combination? I don't know. But New York City, Manhattan landlords are not going to let their property sit empty too long. It costs them too much money. Now, as far as they're replacing them with experiences, I have absolutely no idea what that means. But that sure sounds
That's
interesting.
why I let you go first, Vic. That's why I let you go first.
I figured so, Joe.
That I was being nice.
Yeah, I figured so. I really don't know what they mean that they're going to replace it with experiences, but I would love to find out what they're going to replace it with. I'd definitely be interested to read that article or articles about it. But I do feel this: they're going to figure out what they need to do to get those office spaces rented, whether they have to convert them or not, or such. But don't forget, well, I should say don't forget, but in the news recently, some of you guys might have seen Manhattan, New York City is becoming a big crypto place. Crypto companies are coming here to Manhattan. They've been writing articles about it. So maybe they're going to fill up some of those empty office spaces very soon.
Okay, so I'm also going to kind of skip the experience part because I'm not 100% sure if that means, because I know some offices are converting where they are making the workplace a lot more fun and for a lot less people. So they're putting in games and they're putting in other things that the employees can enjoy. I know they started doing that. I saw for the first time in Charleston, South Carolina, and a couple of big offices that were filled with with employees. Now that semi-remote, if you go back into that office, they've added a lot of different things to it. But if you talk about conversion to residential, I have one building that's very interesting that Compass is actually handling the conversion. I don't have anything specific to do with it, but I did do the walkthrough several months ago where it's at 1 Wall Street. So right in the middle, Wall Street, right in the middle of the business center that was thriving when I went to Pace. It was packed every single day. And every office building was more than packed because they were hiring like crazy. There were tourists all over the place. So I went and I toured the building, beautiful, beautiful building. And I think in the initial stages of it, it was taking a while to find buyers for the condos. It's picked up since then. I think long-term, it's going to be awesome. It's going to be great. But in this environment right now, just post-COVID, it was really a weird sensation. I left the building. And I walked, and I was impressed. The lobby is the same as it was. It's absolutely gorgeous. And then I left the building at about 11 o'clock and I start walking down towards the ferry. And that was the same walk I would walk when I walked from Pace to the ferry, walk down Nassau Street, Broadway to the ferry. So I'm walking down right in front of the Federal Building and the Stock Exchange. And it was 11:30 in the morning. And there was like 15 people in the street. That was just like when I was walking back from the Pace pub at 2 o'clock in the morning, it would be 15 people. Okay. And unfortunately, I did that a lot more than I probably should have. But that's what I felt like. I said, wow, it's light out. How is this even possible? And then I said to myself, wow, how is this transition going to happen? Because, that's a phenomenon. I think people aren't recognizing how many people were in that building and how many tourists were outside there. So the foot traffic is way, way, way less. But again, long-term, as Vic pointed out, the city resiliency is amazing. So I think that an investment like that is a really smart investment for someone, but it's taking its time right now because of these issues. I mean, it was really phenomenal. It really, I can't tell you how it impressed me. The fact that there was nobody in the street.
Interesting. Joe, based on what you just said, you had a much more exciting experience at Pace University than I did.
Yeah.
And you had more fun.
I'm glad none of my fraternity brothers are on this. Otherwise, they'd be unmuting themselves and singing the frat song, but trying to embarrass me. They're very, very good at that. But anyway, yeah, I did have a good time. But thank you.
Yes. Well, fascinating. Wanted to turn to a question that came in, and it's regarding the volatility of the stock exchange market. And how do you think that a continuing correction in the financial markets will impact the New York City real estate?
I personally think it's going to have a big impact if it continues. And it did, obviously, in 2008, right? After 2008, when the market started to go down, there was a double whammy on that because there were foreclosures and the market went down and the stock market went down, to a large extent. And that's why it took so long to recover. And right now, with the stock market sort of behaving the same way, if it continues to act in that way, in that fashion, then even VIX cash buyers become at risk, because a lot of the money with the wealthier people are tied to the stock market. So it really has to have an effect. You know, there is a pretty direct correlation over time. Whenever the stock market goes down, or God forbid crashes, it's pretty direct correlation on real estate. So you can't get around that. I can dance around it as much as I want, but you know, it's not going to be believable. So if there's a tremendous correction, or God forbid crash, which I don't think anybody really anticipates, I think that we can weather a correction for sure. There's no question about that. It's just that if it goes down to a long-term bear market, it would have its consequences on real estate as well.
Mhm.
Yeah, I think that's we have a couple of minutes, right, Grace?
Yes, we do.
Oh, okay. Yeah, I think I agree with everything Joe says. Excellent points there. You know, if the stock market stays, first of all, I think we already are in the correction with the NASDAQ, and we're probably not that far off from the Dow Jones. And yes, I think that, you know, if the market keeps on going down or stays down, it is going to affect sales in Manhattan, in New York City, in a negative way. You know, I did a sale in the summer. I sold my clients a 2-bed in Lincoln Center, and bought them a bigger 3-bedroom in Nomad. And they sold their stocks to pay for part of that purchase price. It was all cash, you know. Now, if their stocks are down, or I should say, if another buyer, their stocks are down, they might not be able to afford as big an apartment, or they might not want to sell when their stocks are down, and therefore not buy a property. So yes, you know, it can definitely affect, and most likely will affect, the real estate market as well. But I'll say one thing, and I don't think most people will like it, but I really thought our markets were overheated. And I'm not a fan of inflation, but taking inflation out of it, I'm glad at least some steam was taken out of the markets, because I think the fall, because if there wasn't, I think the fall and the pain would be much more intense 2 or 3 years from now as well. Okay. So I'm glad a little steam was taken out. I'm going to say little, you know, we don't want to get too much.
Yeah.
But I think it has a silver lining in that sense. But hopefully, you know, things will start to stabilize, and the Fed will get inflation relatively under control soon. And, you know, once these supply chain issues decrease, which I hope is soon, I think it's going to be a big boon to the entire world economy, as well as New York City real estate. Hopefully soon, cross fingers.
Yes, thank you for that optimistic view, cross fingers. Before we close, could you both chime in? Is it a good time for to join the real estate market as a sales agent or broker?
I also read in one of the NAR articles about a week ago, might have been the same article that I was referencing before, that NAR just announced that it's a record amount of agents entering the marketplace, which I find amazing, because a lot of agents are waiting to see things start to stop and to slow down. But at the same time, even our local board is saying that there's more agents now than ever before. I think we have maybe 200 or 300, or maybe, yeah, 200 or 300 more agents now than we ever have. And I find that to be very unusual. And I would say that it is not a good time to enter. First of all, if you enter the market as a real estate agent, I always advise that it's a full-time position, not a part-time position. But if it's a full-time position, especially, and you're going to count on your livelihood on it, it might be good to prepare for it, but I'm not sure that now is the time to go all in, because I do think, if nothing else, things are going to slow down. I'm not saying that the real estate market's going to start to go down in any significant form, unless those other things happen that I mentioned. But I think that it's going to start to stagnate, and there's going to be less activity. There's less activity And there's a lot of pressure on how realtors do business from the state legislature. It's just a difficult profession to enter at this point. I mean, there's always exceptions to every rule. If there's a situation in your life that makes sense, where you're connected with people who own real estate, or you're very popular in the community, then by all means, it's always good, and you're willing to learn and put the hard work in to become a successful agent. I think any time is a good time. But right now, in general, I would say absolutely not. If I had to say, I would say no. I would say no.
Vic, do you feel any differently?
I feel the same and different. And this is probably the only point Joe and I have disagreed on, or have differing opinions. I think it is a very hard business. Yeah, I really think you have to want it if you want to be a real estate agent. And to me, it doesn't matter what time, it's still going to be hard, whether you're in an up cycle or down cycle. Being a real estate agent is very hard. It's, in one way, it's like any other job. It has its pros and it has its cons. And if the pros outweigh the cons for the man or woman, great. But it's going to be hard no matter when you join, but it really does have its great rewards. Joe's been in real estate, I think, longer than me. Joe, what have you been, 25, 30 years? I've been doing real estate agency for a little bit over 15. But I would say if someone has the strong desire to be an agent, just jump in and go do it. And, you can, although doing it full-time is better, you can still do it part-time. And what I like about the part-time agents sometimes is this: if they're doing it part-time, it probably means they have another full-time job. And that means it's going to take so much pressure, so much financial pressure off that agent, because they have the full-time job and they have steady income coming in. And that takes a lot of financial pressure. Most agents leave, and 90% of agents leave within their first year because of the emotional stress and the financial stress. So if you're coming in part-time, yes, it could work. Is full-time better? Yes, but there is a big plus to doing it part-time. I started full-time when my spouse had a salary job, okay? And I mentally prepared her before I started. I said, it's gonna be a rough couple of years. So I wanted to make sure, and I told her this right before we got married, okay? So I wanted to give her a way out, but she stuck it out. I mentally prepared her, and we had her steady paycheck, and that really helped. But I succeeded because I have the desire. I really had it. And I never had it up until like a year or year and a half before I started real estate. I was always happy to work for someone, get a check, had probably zero entrepreneurial spirit. And then something slowly started to change. And I really got into wanting to be an entrepreneur. And that's what you are when you're a real estate agent. So I think, if you plan and speak to if you're thinking about becoming a real estate agent and you speak to some experienced agents, whether it's Joe or myself or both of us, and you find out what you're getting into and you prepare and you have the desire, then don't worry, just dive in. Because I remember I joined in 2007, the Great Recession hit in 2008, but we did more rental deals in 2009 than ever before. We set a record that year. So yes, we were making less money, all agents were, for rentals, but there was more activity going on, okay? So if you got the desire, I say do it, but definitely, like Joe said, learn what you're getting into and learn how best to prepare, and then give it a shot. So I think if you're ready to do it. That's my opinion. I'll say one last thing. I really wanted to get out of accounting. No offense to accountants. I see why people stay in there their whole life. I needed to leave for my mental sanity as well. So, that's why when someone says it's a good time to get it, I say yes, because maybe you need to leave for your mental sanity as well. Maybe you need to get out of that job or career path and you need a change. And sometimes just doing that for mental sanity is great as well.
Well, not to insult anybody, but maybe versus accounting, it's a good time to get in.
Okay, fantastic. We have reached the end of our webinar. It has been a very exciting, dynamic hour. Clearly, this is such a relevant topic. We'd like to extend a great deal of thanks and appreciation to our two experts, Vic and Joe, for spending the time with us. We'd like to thank all of you for joining us. We look forward to seeing you at the PACE upcoming reunion, and it's in the details are in the chat, and you can see it. It just got up here again. So thank you, every one of you, for joining us, and we look forward to our next webinar with you.
Thank you, guys.
Grace,
thanks,
and thank you, Pace.
Thanks, Grace, Mark, Michelle.
Yeah.
Thank you all for listening.
Okay.
Thank you.
Thank you, everybody.
Bye.